Hello and welcome. If you're a UK property investor, you know that tax can feel like a labyrinth, just designed to trip you up. But what if I told you there are pathways through that maze? Hidden loopholes, really, that could save you a serious amount of money. Today, we're going to uncover those secrets. So let's just start with a really direct question. Right now, are you paying thousands, maybe even tens of thousands more in property tax than you actually need to? Because for a lot of people, the honest answer is yes, and they don't even know it. Now, this entire discussion has been developed by the team at Pro Tax Accountant. These folks are specialists. They live and breathe the complexities of UK property tax every single day. So you can be sure the strategies we're about to explore are straight from the experts on the front line. Think of your life as a property investor as a journey with three distinct stages. First, you buy, then you own and hopefully profit, and finally, you plan how to pass that wealth on. Each of these stages has its own tax traps and, crucially, its own opportunities. Let's navigate this maze, starting at the very beginning. So, the first hurdle you've got to clear is stamp duty land tax, or SDLT. You can basically think of it as the government's cover charge for getting into the property game. It's that big, upfront tax you pay when you buy a property. And if you're buying a second home or a buy-to-let, well, this fee gets a whole lot bigger. And this is where it gets really urgent. Just look at these numbers. For the exact same £250,000 property, your tax bill literally doubles in the space of a few months. It goes from $7,500 to $15,000. This isn't just a small jump. It's a massive escalation because temporary reliefs are being phased out. So let me be clear. These dates are not just guidelines. They are hard financial deadlines. Missing them could cost you a small fortune before you've even picked up the keys. Okay, so you've navigated the stamp duty and you've bought the property. You've got the keys in your hand. Now the real game begins, making that asset work for you and generate rental income as tax efficiently as possible. So how are the smartest investors doing it? Well, the answer is kind of hiding in plain sight in one very telling number. 74%. That's a huge number. In 2023, nearly 3/4 of all buy-to-let properties were bought through a limited company. Now, that is not a coincidence. That is a deliberate, calculated strategy. And it just begs the question, right? What do all these investors know that maybe you don't? And this right here is the why. It's a tale of two landlords. Let's imagine Chloe, a small business owner in London. If she owns a property in her personal name, she only gets a little tax credit on her mortgage interest, and it's capped at the basic 20% rate. Now, if she's a higher rate taxpayer, that really hurts her bottom line. But here's the game changer. If she owns that same property through her limited company, 100% of that mortgage interest becomes a deductible business expense. It slashes her taxable profit before it even gets looked at. And then that profit is hit with corporation tax, which can be much, much lower than her personal 45% income tax rate. It's a total game changer for her cash flow. So, the big takeaway is this. This isn't just about ticking a box on a form. Deciding how you own your property is probably one of the biggest financial decisions you'll make as an investor. It changes the math completely and sets the foundation for how you grow your portfolio. And you'll want to stay with me here because this choice has huge implications for the final stage of your journey in a way you might not expect. We've talked about buying smart and owning smart, but there's one last crucial piece to this puzzle: your legacy. After all those years of hard work building your portfolio, how do you make sure it goes to your loved ones and not in a huge chunk to the tax man? And that brings us to the final boss of property tax, inheritance tax, or IHT. It's a staggering 40% tax on the value of your estate above a certain level. For many successful investors, this can feel like a devastating final bill that undoes years of hard work. But, and this is a big but, it doesn't have to be. So let's start with the basics everyone gets. You have a tax-free allowance called the nil rate band of £325,000. On top of that, if you leave your main home to your kids or grandkids, you get another £175,000 allowance. And here's a pro tip for you. These allowances can be shared between spouses. So if one partner passes away without using all of theirs, the survivor inherits them. This means a married couple can potentially pass on a cool £1 million completely free of inheritance tax. But what happens if your portfolio is worth more than that? Well, this is where it all clicks into place. This is the master key. It's called business relief. It is an incredibly powerful tool that allows qualifying business assets to be passed on with 100% relief from inheritance tax. Yep, you heard that right, 100% tax-free. And what counts as a qualifying business asset? You guessed it, the shares in that property investment company we were just talking about. This is how owning profitably connects directly to passing on your wealth.
But, and I cannot stress this enough, you need to listen up because this is urgent. The government is about to move the goalposts. Huge, seismic changes are coming to business relief from April 2026. This isn't just a minor tweak, it's a fundamental shift. And the window to use the current, much more generous rules is closing very, very fast.
This chart spells it out perfectly. Right now, your entire qualifying business could be passed on with 100% relief. But after April 2026, that 100% relief gets capped at the first £1 million. Anything above that, the relief gets slashed in half to just 50%. For a larger portfolio, this is a massive deal. Let's put some real numbers on it. For an estate with a £3 million business, this change could trigger an extra £400,000 in tax. That's a huge sum of money that could have gone to your family. Okay, so we've covered a lot: rising costs, changing rules, and powerful strategies. The big question now is, what should you actually do with all this information? Let's boil it down to the essential next steps you should be thinking about right now. Here are your key takeaways. First, act now on any planned purchases. That rising stamp duty bill is real and it's coming soon. Second, structure smart. That limited company isn't just about saving a bit of tax. It's the cornerstone of a profitable and legacy-proof portfolio. Third, plan ahead. That 2026 deadline for business relief is much closer than it feels, and proper estate planning takes time. And one more thing to be aware of. The favorable tax regime for furnished holiday lets is being abolished in April 2025. So if that affects you, you need a new plan for that too. Now, for a very important note. Please remember, the information we've discussed today is for general guidance. It's designed to open your eyes to the possibilities, but it is not a substitute for professional, tailored advice. Your situation is unique, so please, before you make any big decisions, speak to an expert. So, after seeing the looming deadlines, the tax traps, but also the powerful strategies available, are you ready to take control and start making your property portfolio as tax efficient as it can be? If the answer is yes, then your next step is to have a conversation with the people who live and breathe this stuff. The team at Pro Tax Accountant can help you create a strategy that's built specifically for you. You can reach them on WhatsApp or by phone at 07985 689 912, or you can email them at info@protaxaccountant.co.uk. Thank you so much.